right, let's jump right in. Today, we're taking a really grounded, honest look at the psychology behind why so many traders completely destroy their consistency. And listen, here is the reality of the situation. It is almost never because they lack a strategy. Most traders actually fail because of the emotional urgency of chasing mature market moves. It's that exact moment when your patience just evaporates and raw impulse grabs the wheel. We've all been there, right? You've absolutely heard that little internal whisper saying, "It's still going." This speaks directly to our deepest insecurities as traders. You're sitting there at your desk, you're watching these massive expansion candles just rip higher or completely plunge lower, and you are not participating. The visceral pain of FOMO, that fear of missing out, kicks in hard. You see the price moving, and that tiny voice in your head starts full-on panicking because you feel totally left behind by the market's momentum. And then that panic evolves into a highly, highly dangerous thought. You tell yourself, "I can't miss this move." This internal panic of feeling left out creates a massive psychological illusion. It literally forces you into low probability continuation traits. You convince yourself that, yes, this is the definitive breakout, but in reality, you're just abandoning your structured plan for the sheer sake of feeling involved. Or maybe it stems from a totally different kind of pain, the classic, "I need to make back the loss." Notice how payout pressure and recent red days just instantly trigger emotional impulsivity. When you're sitting in a drawdown, the pressure mounts, and you start telling yourself, "Come on, I just need one good trade." Suddenly, your calm, structured session is completely tossed out the window, and it turns into this desperate cycle of revenge entries. You've stopped trading the actual market, and you've started trading your P&L. So let's clearly define the exact trap we are falling into here. We're talking about emotional urgency. It is the overwhelming compulsion to execute based on the fear of missing out, internal panic, or the desperate need for immediate recovery. And it completely overrides any structural market logic you have. The absolutely crucial point to understand is that this urgency fundamentally weakens your confirmation standards. It completely distorts your perception of price action, making terrible late setups look like they're high probability entries. This urgency creates a stark, undeniable contrast between two totally different types of market participants. On one side, you have retail reactive execution. This is the chasing breakouts, the emotional forcing, the panic entries, basically praying to the market gods. On the exact opposite side, you have institutional structured execution. This is waiting for equilibrium, waiting for liquidity sweeps, and executing with strict timing. Looking at this is like holding up a psychological mirror. It shows the chaotic, stressful reality of retail habits matched up against the cold, mechanical patience of institutional operators who rely on risk models, not hope. So, let's break down exactly how expansion distorts our perception. Why do large, fast-moving candles chemically trick the human brain into completely abandoning a well-thought-out trading plan? Well, when emotional urgency takes over, the degradation of your analysis is severe. Suddenly, weaker setups appear totally valid. Your confirmation standards just drop off a cliff. Your continuation bias goes through the roof, meaning you start believing the market is just going to run forever in one single direction. And finally, overtrading steps in to completely destroy whatever edge you had. Your discretionary analysis degrades so heavily under stress. This proves, without a doubt, that your trading edge is highly dependent on environmental and emotional filtering. Without emotional neutrality, your edge is practically zero. Which brings us to a really pivotal question, and I want you to ask yourself this right now. Why do mature market moves almost always retrace aggressively? Really think about it. We want to pivot away from emotional reactions and focus on logical market mechanics. When you buy the absolute top of a massive expansion candle, what is actually happening behind the scenes? Let's dive into the mechanics of market timing to figure that out. To answer that question, we have to face institutional reality. The market is not random, guys. It operates on a strict schedule, heavily focusing on liquidity delivery and order pairing rather than just random directional movement. Take a look at the hourly AMD cycle. From minute 0 to 12, you have accumulation. This is where the orders are quietly building up. From 12 to 20 minutes, you have manipulation. That's the stop run that purposely trips reactive traders into the completely wrong direction. And then from 20 to 30 plus minutes, you get the distribution phase. That is the true engineered move. By mapping out these predictable phases, we can prove the market runs on specific time windows. Chasing early movement before that manipulation phase is just fundamentally and mathematically flawed. So you need to calmly remind yourself of this absolute truth. The market is highly efficient. It only ever creates inefficiencies to rebalance them later. When retail traders give in to FOMO and buy those really late breakouts, they are simply serving as liquidity for institutional participants. You are quite literally buying exactly where the smart money is securing their profits. Remember, order pairing requires a buyer for every single seller. And your emotional urgency, well, that makes you the absolute perfect counterparty. And that right there is why structured execution requires very specific data-driven anchors. We're talking liquidity sweeps, clean displacement, timing alignment, and controlled pullbacks to equilibrium. Keep in mind, big money does not participate in erratic, unconfirmed price action. They aren't guessing. They look for a systematic edge with clear visibility, and they will wait for those exact conditions before putting a single dollar of capital at risk. So I really want to ask you this directly, and I'm going to take a deliberate pause to let it sink in. If the structural map isn't here, why are you? You have to stop negotiating with your boredom, stop negotiating with that constant nagging need to just click a button. You have to realize that no map equals no participation. If the setup is not there, sitting on your hands is the absolute only correct action to take. Which leads us perfectly into the skill of doing nothing. If we want to build a new framework, one where patience is viewed as your ultimate edge rather than just inaction, we have to introduce a strict, non-negotiable rule: 7 out of 10. If your emotional neutrality ever drops below a 7 out of 10, all trading must completely and immediately cease. You must protect your capital, absolutely, but just as importantly, you have to protect your mental clarity. There is simply no negotiating with emotional urgency. You cannot trade effectively when your judgment is compromised. Just look at the clear distribution of outcomes between these two distinct states. When you're in an emotional state, your default behavior is forcing, overtrading, and chasing. The outcome of that? Straight up account destruction. But when you operate in a neutral state, your behavior shifts to waiting, selective participation, and patience. And the outcome there is sustainable profitability. It is a very simple mechanical separation between failure and success. This maps directly to a professional operator's true priorities. We call this the survival hierarchy. Number 1, survival. Number 2, risk control. Number 3, process. And way down at number 4, profit. I want to sequentially lay this out so it really hits home. Protecting your capital and staying actively in the game always comes before capturing profit, because without survival, you literally have no opportunity to ever exploit your edge. And that brings us to our final concept: consistency of self. Sustainable profitability does not come from perfectly predicting what the market is going to do next. It comes entirely from controlling your own behavior. Really internalize this quote: consistency is behavioral repeatability under uncertainty. True consistency isn't measured by pulling a massive daily profit or passing some funding challenge in a single afternoon. It is measured by your ability to execute the exact same mechanical behaviors, whether you win or lose, over weeks, months, and quarters. And I want to say this next part slowly. Doing nothing is a high-skill activity. Sitting on your hands and waiting for that distribution phase requires significantly more discipline than impulsive clicking ever will. It's not boring, it is the absolute epitome of institutional control. We'll wrap up this explainer with a lingering, impactful thought for you to carry into your next session. Patience creates precision. Only timing survives the noise. You have to leave that emotional urgency behind. Approach your next session with cold, institutional calm, wait patiently for your structured opportunity, and maintain your process integrity above all else. Thanks so much for tuning into this explainer. Just remember, survival is what creates opportunity. So before your next session, ask yourself, are you trading the market structure? Or are you really just trading your own impatience?